Before we begin, let me tell you something that happened recently, because it's the reason this conversation matters right now. About 3 weeks ago, my phone rang. The number wasn't one I recognized, and when I answered, it wasn't a journalist calling for a quote or a colleague asking about markets. It was someone I hadn't spoken to in more than a decade, a former Treasury official who spent over 20 years working deep inside the financial structure of the United States. People like that don't call casually. And when I picked up, he didn't start with small talk. He didn't even say hello. The first words out of his mouth were simple and direct. He said, "Stanley, how much cash do you currently have outside the banking system?" I answered him honestly, and then there was silence. A long pause on the other end of the line, the kind of pause that tells you the person is thinking carefully before speaking again. Finally, he responded with a sentence that stuck with me. He said, "Double it before April." Now, I've spent more than 40 years operating inside financial markets. Over those decades, I've witnessed situations that would make most investors panic. I've seen currencies collapse, liquidity vanish, credit markets freeze, and entire economies come close to breaking apart under pressure. I've lived through events where the global financial system looked fragile enough to unravel. Experiences like that tend to change how you react to warnings. I don't get frightened easily, and I certainly don't change strategy because of rumors or headlines flashing across financial television. Decisions in my world come from data, historical patterns, and the behavior of markets, repeating the same cycles again and again. Human behavior rarely changes, and neither do the underlying mathematical realities driving financial systems. Right now, those patterns are showing something unusual. In fact, what I'm seeing is something I have not seen in 4 decades of analyzing markets. The evidence is becoming so clear that ignoring it would be irresponsible. That is exactly why I decided to record this message. I'm Stanley Druckenmiller. For 30 years, I ran Duquesne Capital. I also worked closely with George Soros during one of the most famous currency trades in modern financial history, the trade that forced the Bank of England to abandon its currency defense and generated over $1 billion in profit in a single day. Over my career, I've navigated multiple major crises and managed to come out stronger each time. I'm not here to sell a product or promote a subscription service. I'm simply sharing what decades of watching markets have taught me, because the signals forming right now should matter to anyone with money sitting in a bank account. So let me ask you something that most people rarely consider. When was the last time you thought seriously about your bank itself? Not your balance, or your credit card, or your monthly statements. I mean the institution that actually holds your money. When did you last question whether that institution is stable, or whether the financial structure supporting it is as secure as people assume? The truth is that most individuals never ask those questions. They believe their deposits are safe because the system appears stable. They believe nothing will go wrong because nothing has gone wrong recently. Unfortunately, that kind of thinking is exactly what leads to financial losses when conditions suddenly change. And today, the risks behind the system are more significant than most people realize. To understand where we are now, we need to revisit an event from March of 2023. Many people remember the headlines surrounding Silicon Valley Bank. News outlets summarized the situation quickly. A bank collapsed, regulators stepped in, and the crisis was contained over a weekend. That is the simplified version that reached the public. But the real story is what unfolded in the 72 hours before federal authorities took control. Something important happened during that short window, something regulators would have preferred people not fully understand. Once you grasp what occurred, the warnings about the coming years begin to make sense. Silicon Valley Bank didn't fail because of fraud, and it didn't collapse because of the kind of reckless lending that caused the crisis in 2008. The real issue was more basic and far more widespread across the banking system. The bank held a large portfolio of government bonds and mortgage-backed securities that had lost nearly 20% of their value. That decline wasn't caused by poor management alone. It happened because interest rates increased faster than they had in roughly 40 years. When rates were near zero, banks invested heavily in long-term bonds. But once the Federal Reserve raised rates dramatically, those bonds dropped in price. On paper, the losses became enormous. When depositors realized what was happening, money began leaving the bank rapidly. Within 48 hours, the institution was effectively finished. Here is the detail that deserves attention. Silicon Valley Bank wasn't unique in holding those kinds of losses. The difference was simply that its situation became visible first. Across the country, many banks were sitting on similar unrealized losses in their bond portfolios. According to data released by the Federal Deposit Insurance Corporation, American banks collectively had more than $500 billion in unrealized losses by late 2023. That number alone should make people pause. Those losses didn't disappear after the headlines faded. Interest rates have remained relatively high since then, meaning the problem has not been resolved. Instead, it continues to sit quietly on bank balance sheets, waiting for the kind of trigger that can suddenly bring it into public view. So the obvious question becomes this: what could trigger the next visible crisis? What turns a hidden vulnerability into a situation everyone suddenly notices? The truth is, the signals are already forming, and most people have not yet connected them. One of the clearest places to start is commercial real estate, an area I've been discussing for years. Many critics have dismissed those concerns, but the numbers speak for themselves. Office buildings across major American cities are experiencing vacancy rates that would have seemed impossible a decade ago. In places like San Francisco, Chicago, and New York, empty office space has reached levels between 20 and 30%, and in some districts the situation is even worse. The reason behind it is simple. Remote work did not disappear after the pandemic. For a large portion of companies and employees, it became a permanent arrangement. That shift has reduced demand for office space significantly. When demand falls, rental income drops. As rental income declines, property values decline as well. And when property values fall far enough, property owners struggle to repay loans. Eventually, some of them default. The important question then becomes, who holds those loans? The answer is not the largest Wall Street institutions most people think about first. Instead, many of these loans sit on the balance sheets of regional banks across the country. These are the same banks already dealing with losses in their bond portfolios. They also rely heavily on deposits that can move quickly, especially in an era where money can be transferred with a smartphone in seconds. According to data from the Mortgage Bankers Association, more than $1 trillion in commercial real estate loans are scheduled to mature before the end of 2026. That is an enormous amount of debt that will need refinancing in an environment where interest rates are far higher than they were when many of these loans were originally issued. For a large portion of these properties, refinancing may not be possible because the buildings no longer generate enough income to support the new loan payments. When that happens, defaults increase and bank losses follow. And that is where the situation begins to resemble the early stages of previous financial disruptions. The detail that rarely receives attention is how these losses remain hidden for long periods. Banks are not always required to mark commercial real estate loans to market immediately the way they do with certain securities. That means problems can exist quietly for months or even years until something forces recognition. A borrower missing payments, a property entering foreclosure, or an auditor requiring adjustments can suddenly reveal losses that had been sitting beneath the surface all along. When that happens, confidence can shift quickly, and depositors begin asking questions they weren't asking before. Now, this is where the story becomes even more significant, because the commercial real estate issue connects directly to something much larger: the financial position of the United States government itself. Understanding that connection is essential because it influences the safety of bank deposits in ways that many people never hear explained clearly. And to see the full picture, We need to look closely at the scale of government debt and what it means for the financial system moving forward. To understand why the government's financial position matters so much to the safety of the banking system, you have to start with the scale of the numbers involved. Right now, the United States government carries roughly $36 trillion in total debt. That number is so large that for most people it almost loses meaning. It becomes an abstract statistic rather than something that affects everyday financial stability. But once you break it down into what the government actually has to pay each year, the reality becomes much clearer. The interest payments alone, just the cost of servicing that debt without reducing the principal by even a single dollar, now run at around $1.1 trillion annually. Think about that for a moment. The entire defense budget of the United States is roughly $900 billion. In other words, the country is spending more each year simply paying interest on its debt than it spends on its entire military structure, including aircraft carriers, personnel, technology, satellites, and national defense systems. And the crucial detail is that the interest burden is rising steadily. Why is it rising? Because government bonds issued years ago at very low interest rates are now maturing and being replaced with new bonds at much higher rates. 2 years ago, the average interest rate the government paid on its debt was around 2.5%. Today, that number is closer to the mid 3% range, and as more bonds roll over, the average rate will continue to climb. Eventually, it may approach 4.5% or even 5% if current trends hold. According to projections from the Congressional Budget Office, within a decade, interest payments alone could absorb nearly 40 cents out of every tax dollar collected by the federal government. Now, this might sound like a government budgeting issue, but it directly connects to the stability of banks and financial markets. When the government runs large deficits each year, it needs to borrow money to cover the difference between what it spends and what it collects in taxes. Recently, that borrowing requirement has been close to $2 trillion annually. To raise that money, the Treasury Department sells bonds, and those bonds must be purchased by investors somewhere in the world. For decades, a large share of those buyers were foreign governments. Countries like China, Japan, Saudi Arabia, and others accumulated trade surpluses and reinvested those funds into U.S. Treasury securities. That steady demand helped keep interest rates relatively low and allowed the system to operate smoothly. However, that pattern is beginning to change. China has gradually reduced its holdings of U.S. government debt from a peak of more than $1.3 trillion to well under $800 billion. Japan, another major holder, has been under pressure to sell treasuries in order to support its own currency. Meanwhile, oil-producing nations and other global investors are diversifying their reserves instead of concentrating them in U.S. bonds. The key point is that foreign demand for American debt is weakening at the exact moment when the amount of debt being issued is increasing rapidly. So the question becomes obvious. If foreign buyers are stepping back, who replaces them? Increasingly, the answer is domestic institutions. American banks, pension funds, and money market funds are absorbing a larger share of new Treasury issuance. That means the U.S. government is effectively borrowing more from its own financial system to fund deficits that are structural rather than temporary. And every dollar that flows into government bonds is a dollar that is no longer available for private sector lending. That affects mortgages, business loans, and investment in productive economic activity. Over time, this dynamic begins to slow growth because the government competes for the same pool of capital that businesses depend on to expand. Now, we need to add another important piece to the puzzle. The Federal Reserve, which dramatically expanded its balance sheet during the pandemic by purchasing trillions of dollars in bonds, is now moving in the opposite direction. During that period, the Fed built a balance sheet approaching $9 trillion by injecting liquidity into the system. Today, it is shrinking that balance sheet through a process known as quantitative tightening. Each month, roughly $60 billion is being removed from the financial system as the Fed allows bonds to mature without reinvesting the proceeds. Over the course of a year, that reduction approaches $700 billion. When you combine that liquidity withdrawal with the massive borrowing requirements of the Treasury, the scale becomes significant. The government may need around $2 trillion in new borrowing in a year, while the Fed simultaneously removes close to $700 billion from the system. Altogether, that represents nearly $3 trillion in liquidity being drained from the American financial environment in a relatively short period of time. That is not a small adjustment. It is a major shift in the availability of money and credit throughout the system. What does that kind of liquidity drain actually look like from inside financial markets? The interesting part is that it rarely appears immediately in dramatic headlines. Instead, the first signs show up quietly in areas that most people never monitor. For example, stress can appear in the repo market, where banks lend to one another overnight to manage short-term funding needs. When those rates begin moving in unusual ways, experienced observers know something beneath the surface is changing. Another place where stress appears is in the corporate bond market. Market makers, the institutions that normally provide liquidity by buying and selling bonds, start pulling back. Bid-ask spreads widen slightly at first, then more noticeably as uncertainty increases. Companies that borrowed heavily at floating interest rates begin struggling to keep up with payments as borrowing costs rise. The leveraged loan market starts showing signs of strain. At the same time, regional bank stocks, which many investors ignore, begin quietly underperforming the broader market. This doesn't immediately create panic. In fact, it can go unnoticed for months. But eventually something shifts. A bank announces it needs additional capital. A private investment fund temporarily blocks withdrawals. A company fails to refinance a loan that is coming due. And suddenly, what had been a slow accumulation of pressure becomes visible to everyone at once. This is how financial crises typically begin. Not with a dramatic explosion on day one, but with a slow leak that gradually becomes impossible to ignore. I have seen this pattern repeatedly over the course of my career. It starts quietly, builds in the background, and then reaches a moment where confidence changes quickly. Once that happens, events accelerate far faster than most people expect. So the real question becomes, what might happen over the next year or so if these pressures continue building? Between now and the months leading up to April 2026, several developments are likely to unfold simultaneously. In commercial real estate, loan maturities will continue arriving, forcing banks to decide whether to extend loans, restructure them, or recognize losses. Many institutions will try to delay recognition by extending terms, a practice often referred to as extend and pretend. But not every situation can be postponed indefinitely. Some losses will eventually appear in earnings reports, and when they do, markets pay attention quickly. At the same time, the Treasury will continue issuing large quantities of new debt. If demand from traditional buyers remains weak, yields may need to rise further to attract investors. One particular level that markets watch closely is the 10-year Treasury yield. If that yield climbs above 5% and stays there, it signals that bond investors are demanding significantly higher compensation for lending money to the government. When that happens, the pressure on bank balance sheets increases because the value of existing bonds declines further. And this is exactly where we begin approaching the question many people are asking right now. If these risks are building, what should individuals actually do to protect themselves? How much money should someone consider holding outside the banking system before April 2026? The answer requires careful explanation because reacting incorrectly could create unnecessary problems, while failing to prepare could leave people exposed. So let's talk about that framework clearly and realistically, starting with what deposit insurance actually covers and why relying on it alone may not be enough in a widespread crisis scenario. To answer the question about how much money someone should consider withdrawing or repositioning before April 2026, we need to start with the basics of how bank protection actually works. In the United States, deposits are insured by the Federal Deposit Insurance Corporation, commonly known as the FDIC. That insurance covers up to $250,000 per depositor per institution. If you have less than that amount in a single bank account, technically your funds are protected within that limit. Many people stop their analysis there and assume everything beyond that point is safe, simply because the system has worked in the past. But the first step, the most immediate and practical one, is simply verifying how much money you hold at any single bank. If your deposits exceed that insured threshold and you have not already diversified them across multiple institutions, that should be addressed quickly. Moving excess funds to other FDIC-insured banks or structuring accounts in ways that maximize coverage is a straightforward adjustment that many investors overlook until it is too late. Another option some individuals use is purchasing Treasury bills directly through the government's platform, Treasury Direct, which effectively means lending directly to the federal government rather than holding deposits within a commercial bank. However, the insurance limit is only the surface of the conversation. The deeper issue, the one more experienced investors think about, is what happens in a scenario where several regional banks encounter serious trouble at the same time. The FDIC maintains an insurance fund designed to protect depositors, but that fund currently holds roughly $120 billion. On its own, that sounds substantial, but when you compare it to the total deposits across American banks, which exceed $17 trillion, the scale becomes clearer. The insurance fund represents less than 1% of total deposits. In a situation involving widespread failures, the FDIC would likely need to request additional support from Congress and the Treasury. Historically, governments do step in when financial stability is threatened, but those processes are not always immediate. During the period between a bank failure and the resolution of claims, depositors could experience delays or uncertainty about accessing their funds. Even if everything eventually stabilizes, that waiting period can create serious challenges for individuals or families who depend on liquidity for everyday expenses. Because of that reality, the approach I recommend is not about panic or withdrawing everything from banks. That would be extreme and unnecessary. Instead, the goal is to create resilience. Every household should consider maintaining 3 to 6 months of living expenses outside the traditional banking system entirely. That doesn't mean hiding money in unsafe ways or acting irrationally. It simply means having a portion of financial resources positioned so that if access to a bank temporarily becomes difficult, your life continues normally. For some people, that might mean holding a portion of funds as physical cash stored securely. For others, it could mean short-term treasury bills purchased directly from the government, or even physical precious metals such as gold or silver stored in a non-bank location. The exact method is less important than the principle behind it. The goal is flexibility and independence from potential disruptions within the banking system itself. To make that more practical, imagine a household that spends around $5,000 per month. In that case, 3 to 6 months of expenses would be $15,000 to $30,000 positioned outside bank deposits. If a family spends $20,000 per month, the range would be $60,000 to $120,000. The amount varies depending on lifestyle, but the framework remains consistent. This approach is not about expecting a collapse. It is about preparing for a period where liquidity could become temporarily limited. The reason the 3 to 6 month window matters is historical. In most major financial disruptions, the period between the first visible shock and the moment when governments and central banks stabilize the system tends to fall within that range. During the financial crisis of 2008, for example, Lehman Brothers collapsed in September, triggering severe panic across markets. By the following spring, policymakers had deployed enough support to halt the downward spiral and begin rebuilding confidence. That span of time illustrates why having several months of independent financial stability can make a significant difference. Now, I want to explain something else that often gets misunderstood in discussions about risk. Being defensive does not mean doing nothing or hiding entirely in cash. It means structuring your portfolio so that you can withstand uncertainty while still participating in opportunities. For instance, at current interest rates, short-term treasury bills yield around 4.5% to 5% annually. That means holding cash equivalents is not necessarily a loss of productivity. You are earning a return while maintaining flexibility. In my own positioning, a substantial portion of investable assets sits in cash and short-term government securities. These are held either directly through treasury accounts or through instruments that are not dependent on traditional bank deposits. The purpose is simple: optionality. When markets become unstable, the ability to move quickly becomes extremely valuable. Investors who remain fully committed to risk assets during uncertain periods often find themselves forced to sell at the worst possible moment. Another portion of my assets is allocated to physical gold stored outside the banking system entirely. This is not because I expect gold to solve every financial challenge, but because it provides a form of diversification that does not rely on the stability of banks or governments during short periods of stress. Over the years, many experienced investors have used precious metals as a form of insurance against systemic disruptions. The key point is not speculation, it is protection. There are also positions designed to benefit if certain vulnerable sectors of the market experience pressure. Areas like regional banking stocks, commercial real estate investment trusts, and companies that rely heavily on cheap credit can face significant difficulties when liquidity tightens. Investors who anticipate those conditions sometimes position themselves accordingly through hedges or short exposure. The purpose is to balance risk rather than simply hope the market moves in one direction. At the same time, there are sectors that tend to perform better during periods of inflation or financial adjustment. Energy companies, commodity producers, and businesses connected to essential resources often maintain strong cash flow even when broader markets struggle. Allocating capital to areas tied to real physical demand rather than purely financial speculation can provide stability during uncertain cycles. The important thing to notice about this structure is not the exact percentages or instruments used. The key lesson is the logic behind them. Avoid assets that depend entirely on cheap borrowing and constant liquidity. Focus instead on positions that remain viable even when credit conditions tighten. Naturally, whenever someone outlines a cautious approach like this, there is an immediate reaction from some investors. They say markets have been resilient, technology stocks keep rising, and the economy appears strong on the surface. It is a reasonable point to raise, and I take it seriously. After all, financial history is full of moments where warnings arrived long before the actual downturn occurred. But there is an important distinction between being early and being wrong. And understanding that difference is crucial when evaluating risk, especially in an environment where the signals forming beneath the surface could eventually determine how the next phase of the market unfolds.